When I first started trading, one of the hardest lessons I learned was that markets are not just charts, indicators, or technical patterns. Markets are living, breathing systems influenced by countless forces, many of which can't be predicted with an indicator alone. Understanding market dynamics, the forces that drive price movements, is essential if you want to make informed trading decisions and avoid unnecessary losses. So, what exactly do I mean by market dynamics? Simply put, these are the factors that impact prices and behavior in the financial markets. And these forces fall into three main categories: supply and demand, economic indicators, and geopolitical events. Each one is important on its own. But when they interact, they create the complexity and volatility we see every day in the markets. Let's start with supply and demand, because this is the foundation of all trading. It's a principle so simple, yet it drives everything in every market, from stocks to commodities to forex. When demand for an asset exceeds supply, prices rise. When supply exceeds demand, prices fall. But the key is understanding what drives that supply and demand. Economic conditions are a big part of it. In a booming economy, demand for goods and services tends to increase, pushing prices up. Conversely, in a recession, demand falls, and prices often decline. Consumer confidence also plays a huge role. If people feel secure about their finances, they spend more, increasing demand. If uncertainty is high, spending drops, and markets reflect that hesitancy. Technology can shift supply, making production more efficient or even creating entirely new products, and government policies, like subsidies, tariffs, or new regulations, can influence both supply and demand dramatically. Supply and demand are only part of the story. Economic indicators give us a glimpse into the health of an economy. And understanding them is critical for traders. GDP, or gross domestic product, tells us whether an economy is expanding or contracting. Low unemployment generally signals a healthy economy, while high unemployment can dampen consumer spending and market confidence. Inflation affects purchasing power, and interest rates, set by central banks, influence borrowing and spending. These indicators often move markets before the average trader even realizes what's happening. For instance, a lower than expected unemployment number can trigger an immediate rally in a stock index, while rising inflation could spook investors into selling bonds or equities. Then there are geopolitical events, which often add a layer of unpredictability. Political stability tends to attract investment, while instability scares it away. Wars, conflicts, trade disputes, and even natural disasters can all disrupt markets. And in today's interconnected global economy, a crisis in one part of the world can ripple across multiple markets. A perfect example of all these factors interacting is the COVID-19 pandemic. When the virus hit, demand collapsed for many goods and services, travel, hospitality, retail, while supply chains were disrupted due to lockdowns and workforce shortages. GDP numbers plunged, unemployment soared, and central banks slashed interest rates while pumping massive liquidity into markets. At the same time, geopolitical tensions arose as countries competed for medical supplies, imposed export restrictions, and navigated border closures. What happened in response? Initially, markets fell sharply. Investors were uncertain, fear was high, and volatility spiked. But then, the combination of fiscal stimulus and monetary intervention stabilized many markets. Technology stocks surged as the pandemic accelerated digital transformation. Those who understood the market dynamics, not just the charts, were able to navigate the extreme volatility and even find opportunity in the chaos. I remember during that period, I had a trader reach out to me who was frustrated by the sudden swings in the market. They kept looking for patterns that weren't there because they were ignoring the underlying forces: supply chain disruptions, economic data releases, and government policies. Once we stepped back and analyzed the market dynamics, the trading decisions became much clearer. They began to see why certain sectors were under pressure, why others were surging, and how to position trades strategically rather than reactively. This is where your own observation and research become critical. You can't control geopolitical events or interest rate decisions, but you can stay informed, track economic indicators, and understand the supply-demand forces behind asset prices. The more you understand these dynamics, the better you can anticipate market movements and avoid being caught off guard. One approach I teach traders is to combine your technical analysis with a macro view. For example, if a currency pair is showing a bullish technical pattern, but unemployment in that country is spiking or political instability is rising, that technical setup might be riskier than it appears. Conversely, understanding that a central bank is likely to cut rates in response to weak GDP data could give you an edge, even if the chart doesn't immediately signal it. A quick case study: during the early months of the pandemic, oil prices crashed dramatically. Supply was constrained due to production cuts in some regions, but global demand collapsed because of lockdowns. Traders who understood this interplay of supply and demand, along with economic indicators like falling GDP and manufacturing output, were able to anticipate the extreme volatility and either hedge their positions or take advantage of short-term trades. Those who ignored these dynamics were caught off guard, losing capital because they treated the market as if it were business as usual. Here's my question for you: how often do you step back from the charts to analyze the bigger picture? Do you consider economic indicators, supply-demand fundamentals, and geopolitical events when planning your trades? Leave a comment below and share how you incorporate market dynamics into your trading decisions. I'd love to hear your perspective. The lesson here is clear: trading isn't just about patterns on a chart. It's about understanding the forces behind the patterns. Markets move for a reason, and those who take the time to understand why, looking at supply and demand, monitoring economic data, and staying aware of geopolitical events, have a huge advantage over those who simply react to price movements. Remember the words of George Soros: markets are constantly in a state of uncertainty and flux, and money is made by discounting the obvious and betting on the unexpected. Understanding market dynamics is exactly how you start to anticipate the unexpected and make smarter, informed trading decisions. Stay curious, stay informed, and always step back to see the bigger picture. That's how you move from being reactive to being strategic in the markets. Understanding market dynamics is not just a tip, it's a skill that will serve you for your entire trading career.
Thank you for listening to the 101 Trading Tips in the Ultimate Trading Podcast, brought to you by bellsforex.com AudioWorks. We hope this episode gave you insights, perspective, and practical ideas to strengthen your trading mindset and improve your decision-making. Stay disciplined, keep learning, and remember, every trade is a step toward building your edge. If you found value in today's episode, don't forget to like, subscribe, and turn on notifications. Sharing the podcast with fellow traders helps us grow and bring even more free trading education to the community. Visit us anytime at bellsforex.com for resources, guides, and tools to support your trading journey. Until next time, trade smart, stay disciplined, and keep building your edge. Happy trading.